Hello students, Namaste. In this video, let us understand industrial finance in India. As we all know, finance is considered as the life force of industry. Without getting adequate finance, industrial development is not at all possible. Due to the lack of adequate finance, industrial development in India could not achieve a significant position and shape. Industries require short-term, medium-term, and long-term finance for meeting their requirements of a fixed capital expenditure and also to meet their working capital needs. So in this video, let us understand the role of industrial finance and various institutions providing industrial finance or sources of finance, and then let us critically evaluate the sources of industrial finance in India. An industrial unit or a business firm, whether it is owned by an individual proprietor or partner or shareholders, undertakes business in anticipation of a future gain or return from it. For setting up in business, the firm has to make advance expenditure before it receives any return. The machines are to be purchased, the factory space is to be purchased or leased, raw materials are to be bought, and wages are to be paid to the employees for their services. So finance is needed to undertake all such activities in business. Entrepreneur need finance for setting up the industry, for running the industry, for research and development. In the competitive world, an entrepreneur has to continuously improve the quality of the product, maybe cost reduction or improving the quality of the product. So he has to indulge in research and development, for which entrepreneur requires finance. For further expansion, industry need to be expanded, production activity need to be expanded to reap the benefits of economies of scale. So for expansion, entrepreneur needs finance. Even for replacement of the machinery, the entrepreneur requires finance. So an entrepreneur requires finance for establishing and carrying out the industry. Industries need a short-term finance for a period of less than 1 year to meet their working capital requirements. Generally, industries obtain short-term finance from the commercial banks in the form of cash credit or on the basis of security or stocks or overdraft facilities. They also need medium-term finance for a period of 1 year to 3 years, and they also need long-term finance for more than 3 years, which they can obtain by way of issuing shares, debentures, attracting public deposits, and also by borrowing from term lending institutions like IDBI, IFCI, ICICI, etc. Important sources of industrial finance are shares and debentures, public deposits, loans from commercial banks, loans from indigenous bankers, term lending institutions, and retained profit. But borrowing from indigenous bankers may be a little bit easy, but they charge exorbitant rate of interest. So generally, industries depend on the commercial banks and term lending institutions, and also shares, debentures, public deposits, etc. Now, uh, foreign direct investment has become an important source of industrial finance. FDI is one of the most important sources of foreign investment flows in most of the developing countries of the world, particularly after announcement of new industrial policy in 1991 and the current policies of liberalization, India has been experiencing an acceleration in the flow of foreign investment into the country. During 1992-93, in tune with the new economic policy of 1991 and new industrial policy of 1991 and the LPG, several additional measures were undertaken by the government to encourage investment flows, direct foreign investment, portfolio investment, NRI investment, and deposit and investment in global depository receipts. FDI nowadays is considered as an important source of investable resources. Developing countries or emerging economies like India transition is increasingly see FDI as a source of economic development. FDI as a source of modernization and employment generation. So they have liberalized their FDI regimes so as to attract foreign investment. Beyond the initial macroeconomic stimulus for actual investment, FDI influences growth by increasing the total factor productivity and more generally the efficiency of resource use in the recipient economy. Technology transfers through FDI generate positive externalities in the host countries. The government of India has undertaken various measures to promote foreign direct investment. As we know, Government of India has put in place a liberal, transparent and investor-friendly foreign direct investment policy wherein FDI up to 100% is allowed under automatic route for most of the sectors and activities where the investor does not require any prior approval. Foreign investors are showing their growing confidence in the immediate and medium term prospects of Indian economy. Various measures have been undertaken to promote FDI in India. Existing companies with a foreign equity can raise it to 51%. Earlier, the limit was 40%. Now, they are allowed to raise to 51% and take over the management of the company. NRIs and overseas corporate bodies are also permitted to invest up to 100% equity in high priority industries. NRI investment up to 100% of equity is also allowed in export houses, trading houses, hospitals, export-oriented units, SIC industries, hotels and tourism related industries also. Disinvestment of equity by foreign investors no longer needs to be at prices determined by RBI. India has signed the Multilateral Investment Guarantee Agency Protocol. It has liberalized the provisions of FERA, Foreign Exchange Regulation Act. As we know that the provisions have been liberalized through an ordinance dated 9th January 1993, as a result of which companies with more than 40% of foreign equity are also now treated at par with fully Indian owned companies. And foreign companies have been allowed to use their trademarks on domestic sales from 14th May 1992. New economic reforms, new industrial policy announced in the year 1991 has resulted in an acceleration in the flow of foreign investment into the country. So India has been experiencing a continuous flow of foreign direct investment in recent years. Various sectors have succeeded in attracting foreign capital. Electrical equipments retained the first spot, followed by services and telecommunications. Government has undertaken various measures to simplify the existing procedure in respect of cases already approved by the Government of India. The RBI has now decided to grant general permission under the Foreign Exchange Regulation Act. The Global Competitiveness Report brought out by the World Economic Forum recently lists several encouraging parameters for the Indian economy as an investment destination. India has been ranked 39th among the 138 countries with regard to Global Competitiveness Index. Over the years, since 1991, the volume of inflow of foreign capital has substantially increased. In 1991, the India's share in the world FDI was just 0.05%. It has increased to 3.26% in 2018, which is the highest percentage held by India. It indicates that the confidence of foreign investors in India, which has increased over the years. The total FDI in India during the period between 1991 and 2018 is 4 lakh 97,084 million dollars, a substantial figure. India has attracted the highest ever total FDI inflow of $81.72 billion in the entire financial year of 2021, despite the disruption caused by the outbreak of the pandemic last year. The total FDI inflow was $74.31 billion in 2019-20. So India has emerged as the highest rising economy due to improvement in goods market efficiency, business sophistication, and innovation. India's overall competitiveness has increased due to improvements in institutions and infrastructure, along with recent reforms such as opening of the economy to foreign investors and increasing transparency in the financial system. India still needs to remove labor market rigidities and the presence of large public enterprises, especially in the utilities and financial sector, make the economy less efficient. Thus, under the present regime of economic reforms, the FDI has been playing an important role in the development activity of the economy and is expected to play a more important role in the near future. So, in this video, we have understood meaning and types of industrial finance, need for industrial finance, sources of industrial finance, and recent inflow of foreign direct investment, which has facilitated industrial development of the Indian economy. Thank you very much.